What's going on, everybody? Does the stock market have further upside to go? That's what we're going to talk about in today's stock market brief. Stonks, they only go up. We have on deck earnings coming out, some big mega cap names coming tomorrow after the market close, but we also have some before the open. We're going to go over a couple of these big mega caps for after the close. I'm going to go ahead and have this picture up so you can screenshot it. These are what is reporting earnings here, and these are the expected moves for the earnings that are current as it stands right now. You can look at these levels, upper and lower levels, and mark them on your charts if you're going to be trading any of these names here. Remember, Microsoft, Google, Visa, those ones trade, after the close. So you might want to look at those more towards the end of the close to see if those changed at all. If you haven't seen my expected moves video, the link is in the description, or I'll try to remember to put a video thing that pops up here so you can see how I do that. These are important levels to watch out for. Typically, what we've seen plenty and countless times is going into earnings, usually one of these levels are hit, and if it exceeds it, it could be potentially two standard deviation move. Now, these are the zones that I usually share here with my Patreon group. What I found interesting here was I'm looking at these stocks that have earnings coming up. So the 1.5 is basically after the close, the day still earning. 1 means pre-market. And I'm noticing here into today's price action, the upside is obviously a lot more minimalized than there is downside. So a lot of these names are reaching to their higher part of these zones, which is quite interesting from a risk to reward standpoint. So we'll continue to monitor that and see how it develops. If we take a look at Microsoft, the expected move is quite large, bringing us to around 260 to a low of 235. So expect more volatility. If it's good and the market perceives it to be good, we can see this rally continue. Same with Google, huge move to potentially up to 105-ish around there, and around potentially down to 96 in a very short period of time. We can come in and tag one of those levels. So a lot of volatility here is still packed in. If you're wondering what I mean by Patreon, I have this Patreon group. You can join $9 a month or just do it annually. It ends up being $90 for an entire year. This is where I give all these type of things, trade ideas. I give you weekly expected moves. I post the zones, basically everything in here. I don't actually list the zones in that because I may or may not remove it. I haven't decided yet. Stock market indicators if you like my charts and stuff too. Remember, if you do this and you join, you need to sync up Discord. I post everything in Discord. I don't post it on the Patreon platform. So once you sign up, you then sync your Discord to it, and there's a getting started video and instructions there. Now let's hop into the 15-minute time frame. So we did pop out of the chop box in the SPY. You can see we had area of resistance right there. Resistance there, and we kind of sold off towards the end, but found a little bit of support right in that range. Overall, we're in bullish context in the short term. Let me reiterate that. In the short term, right? Why? Well, we're above an inclining 5-day moving average. Yeah, if you look back to the left of your screen, very, very choppy, volatile trading action. So this could literally come right back down. But if it does come right back down, okay, what do we got to pay attention to? Well, the 5-day moving average, and we'll get into some daily time frames momentarily to give you even more clear of a view. Now, if we get the earnings come out and they're better than expected, or the market perceives them to be better expected, pay attention to the upper expected move for the SPY right around 386. I'll share that in a screenshot here momentarily. As it stands now, another very strong follow-through day, and we have a subtle divergence that is currently building there on the RSI. If you take a look at the Qs, we're in this chop box still, pretty far off from the upper weekly expected move, pretty far off from the lower weekly expected move. And what I've noticed is we're in this very tight rising channel. So we have, a connection right here. We have one right here. We have one right here. We have one right here and one right here. So this price action is just pinging in, within this tight channel. So if it breaks, watch out. We can possibly come down and test the 5-day moving average, which could potentially give us another entry. We had a pullback earlier today, which was nice. And then basically if you're playing the U-turn strategy, right? I shared that on a YouTube short where if you just anchor a daily VWAP, it looked like this. Price basically started up. It started forming a U, and then you just buy into that area. And we basically rode that all day long. So I do have a little bit more long exposure. It's minimalized. It's against some short positions just to have exposure if this market wants to continue to obviously rip. If you take a look at the IWM, not the Qs, this is forming somewhat of an inverse head and shoulder. You can see a left shoulder head right shoulder, and then you see a kind of like a higher low right there. It's building up to this 174 area resistance. So if we do break that, that sets the door to come at least tag 179, which is its upper weekly expected move. I will note that we do have a subtle divergence that is building there. You know, divergence that's somewhat building right here too, as price action's trying to make new highs. The momentum is slowing down there clearly. And we do have price still above that inclining 5-day moving average. If you look really close, you might look at this as like a little wedge, right, with that negative divergence. So yeah, price can very well come right back down. So just be aware of that. Once again, we'll talk about some key levels, but one of the key levels here that I'd watch out for is a break below 171. If that's taken out, you know, that opens the door to come fill this gap over here, or potentially even the lower weekly expected move. Now, if you want to take a screenshot of this too, this is the SPX, the SPY, the Qs, the IWM. These are the levels for the upper and the lower weekly expected moves. So go ahead and screenshot that, and you can mark those on your charts as well. As far as indicators go, we do have a subtle divergence building in, you know, the smart money, dumb money indicator. So we have smart money up top, that's the bonds. We have the dumb money below, that's the equity market. You can see here, smart money is putting in a lower high, whereas the dumb money is putting in a higher high. So the divergence is currently building. This can break, right? HYG is coiling up, so there's a possibility that we start breaking out to the upside. I will note that this could be a potentially larger divergence if you just go like this, whereas even if it starts breaking up, is it going to take out this prior high if SPY continues higher? So we could continue that divergence. It could continue to build. It's something to pay attention to. Somebody had asked me, like, okay, but like, can you really rely on this indicator? Is the correlation really that great? Well, all you need to do to really look into this is pull up a correlation chart. So I'm pulling up a correlation chart. It's HYG correlated to the SPY. Okay, and I'm doing it on different time frames. I'm doing it on short to longer term, so 15-day, 30-day, 90-day, and you can do it on whatever time frame you want if you pull it up, but pay attention to the zero line. The zero line is right here on the screen, okay? So what you notice is if you just take a line across, boom, boom, and boom, what do you notice across all of these time frames? Well, from a larger time frame, a 90-day time frame, very rarely is it a no correlation or negative correlation. The majority of time, it's spent up in a positive correlated state. Same thing goes for right here, and the same thing goes obviously for the shorter time frames. You'll get these uncorrelated moments, but overall, from a longer perspective, the correlation is quite, it's almost darn near at 1, right? You can see the ratings right here on the correlation, 0.88, 0.92, 0.95, very highly correlated. So if they start breaking apart, that could be an indication of a divergence that's building, and it'll have to recoup itself at some point. Now, if we keep going, let's take a look at the dollar. Dollar was slightly down on the day. It is in this contraction type pattern, right? Expansion. You can see we had a strong move up. Now it's contracting, so watch for a potential breakdown. That could probably rock this market up higher. And if it wants to start popping back up, I mean, the market could still potentially go up on good earnings, but just be aware that if it starts breaking out of that 114, right area right over here, that can really rip these markets to shreds again. And you tie this on the back of a rising 10-year yield. This thing hasn't even backed off a little bit, so 10-year yield continues to go up. That's going to apply pressure on tech if this keeps going up. It's just too hard for tech to hold up with this thing just constantly going. Now there is a subtle divergence building here. Subtle divergence building here as price action is going higher. We have, a lower high and a higher high, and then we have a lower high or matching highs to that higher high there too as well. And if you just look at a side-by-side comparison, say for example the Qs up top right here, so Qs in the 10-year yield, what we got here is a positive divergence on the Qs, right? We just talked about a negative divergence on the TNX. So you can see price action was, putting in lower lows, and now we're starting to see a little bit of a pop. So if this starts coming off, that might help, in the short term, potentially, to see a little bit of elevation into the Qs to get a continued rally. Meanwhile, if you take a look at TLT, it was down again today. These things are just getting completely thrashed. So you got to be careful, right? There's so many different warning signs right now. This is not the time to get like full bore long and just throw caution to the wind, right? If you want to get exposure, but make sure that you're still monitoring and managing your risk as the days progress. So price action is getting down here to the lower bound of this channel, which could present itself a bounce. If that bounces, 10-year yields, like I said, might come off a little bit, right? And then that could also help elevate the Qs and potentially the other markets as well. If we take a look at the divergences that are building between the S&P 500 TLT ratio to SPX, just look at this thing, right? So we're at this trend line of resistance right here on the SPX. And this thing is just straight up like a rocket ship. So you got to wonder, like, if if there's a safety trade that happens, right? And by the way, typically when these divergences happen, the SPY ends up getting crushed. So warning shots, right? So these are, times to be very careful. But you got to wonder, like, if the if the S&P 500, or sorry, if this starts moving and yields go down, right? Remember, this is more of a safety trade. It's always been, a way to protect money, and it just hasn't been this year. So if this starts to rise and the S&P 500 starts to fall, is safety trying to enter the market? Is that going to be a risk off type move? Or if this starts rallying, is the S&P 500, the Q is going to start going with it? It's to be determined. I wouldn't put too much weight on trying to like pinpoint that exact answer and just wait for price action to confirm. If you take a look at the volatility indicator where it might be around the corner, this thing is just firing off like a rocket ship. So to me, there's still a possibility that volatility could very well come in the very near future. So be on lookout for that. And if I look at just the VIX by itself on the 30-minute time frame, it's just been ping-ponging around in this channel. Somebody could call it a flag, just like this was calling a wedge. This was an area of resistance, and we blew out of it. Okay, we did crack down through this, right? These higher lows, right? We back tested it right here, and we're starting to break down. But keep in mind, we have all these open gaps, and these open gaps can typically get filled. If that's the case, well, guess what? The market can rally. It can rally really good. However, we do start breaking out of this. Watch out, right? We're not too far off, and we're not like at a low point. We're right there. We're still in we're just about the 30s, high 29s. This is where people get, torn apart. You got to be very careful. This is where the market can swing 2% every single day. That is huge moves in the market. So we need to continue to be very, very careful. Let's go back to this chart. And I want to talk about, how far this could potentially go, or, some key levels to watch. So as we already discussed, the weekly expected moves, I want to pay attention to this. You're going to see a lot of lines on the screen. It's going to look confusing. The pink line, that's the only simple moving average. It's a 200, and you can see it acted as resistance right up in this area and right up in here, okay? And then the white line, that's a trend line. The trend line is connecting basically these high points, and there's all bear market rallies that, ran into those levels. Bear market rally, bear market rally. Hey, can we get a bear market rally up into this level? Hey, absolutely a possibility. These lines are anchored VWAPs, and what I did was I just anchored them to every single start date of the month, or when the month started trading. So basically what you see here is you got January, February, March, April, May, then this is June through August, and then September, October is right down beneath us in different colors. So I wanted to call out that today we got above the September month to date anchored VWAP, and we saw some bullish price action going through that. We're above the October month-to-date anchored VWAP, and we're above the anchored VWAP measured from the low right there in 2022. So a key level to watch on the downside is going to be these two anchored VWAPs, the low matched with the month-to-date, the current month-to-date anchored VWAP. So right here at the low of this candle. So as long as we're trading above that right there and above an inclining 5-day moving average, things are looking healthy for what we can call them healthy in an overall downtrend where we're getting a potential bounce. Now, if we get continued move, that 390 level is going to be highly important. That right there is in confluence with June through August. All those lines are converging. So basically it's saying that if you anchor the average, anchored VWAP to these prices, most of all the average volume traded within those areas are underwater. So going up into that level, right? Understand that people might, I'm just going to take advantage of, coming into this average area and potentially getting out of my position or exiting or taking some profits because, it's a highly, sentimental type area or level to watch out for. Now, if we start breaking above that, we have the May one, which is right near 390. And if we just go back to where we were over here, where does that take us? It takes us to right around that upper weekly expected move, okay? So that is going to be a key level. There's a lot of confluence up there. If we get some sort of hot shot right up there and you're long, could be an area to potentially take a little bit of profits off the table and or manage risk by just updating your stop loss. That's all I got for you on today's episode, everybody. Hope it helped out. See y'all later.